Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hi, everyone. This is Gary Wilson, and welcome to this week's Real Estate Investing for Professional Men and Women, the weekly podcast for all of us professional types, typically, chiropractors, engineers, teachers, firemen, pilots, who are interested in investing in real estate, and we do so honorably and ethically in our areas. We want to make it win-win for everybody, the community, the tenants, of course, us, the owners, the investors. And we have a great community going on. If you haven't really paid attention or noticed yet, you can go to myinvestmentservices.com, click on the members area, and see if you want to become a regular participant. We get together weekly live, talk about transactions, different areas of the country, lots of good data, lots of good information, and we're over 3,000 strong now. And the good news is, for all of us investors, is I've actually trained over 20,000 real estate agents how to service. I'm an investor for 34 years and a broker for half of that. And I did that because I recognized most agents weren't able to really help us invest. So the good news is you got a safe place to go and get some support and some networking. In any case, if you haven't subscribed to the podcast, of course, it's on probably 75 different channels, iHeartRadio, iTunes, Stitcher. So feel free to subscribe, and we love to have you on weekly. So in any case, today's subject is I've got a special guest, Peter Lazaroff, and Peter comes from the investing world, but not the real estate investing world. So I thought this would be a great compliment and very fitting for all of us because, I don't just preach real estate. I do invest in real estate, obviously. But over the years, I've made quite a bit of money in the stock market too. Great mutual funds, individual stocks, things like that. And I didn't do it by myself. I had help, and a lot of help with a lot of research and a lot of data. And when you're a professional and you own your own practice, like maybe you're an orthodontist owning your own orthodontic practice, you're busy. And then I know because I have a business too. But the reality is you can leverage your business to acquire other assets, if it's structured properly, and position yourself so that when you're ready to retire, you don't have to worry about being stuck behind the chair. So, anyways, without further ado, Peter, I just want to say thank you for taking your precious time to do this, and welcome aboard. Welcome to the podcast, man.
Hey, thanks for having me, Gary. I'm really happy to be here.
All right, excellent. Hey, just to start, I know a bit about you. I know we have friends in common, like Dustin, for example. But if you could, for those who haven't heard your name before, would you mind just kind of going in just a background, just to bring some context to why it is you're doing what you're doing now and how you got there? I think a little bit of a story would probably help people see a bigger picture here for themselves,
Sure. Well, let me give you exactly where I am today, and then I'll kind of give you the story of how I got there. Today, I serve as the Chief Investment Officer at PlanCorp, which is a national wealth management firm. We manage a little over $4 billion for our clients across 44 states. I have really led a very fortunate career, I feel like, because my career maybe arguably started when I was 12 years old, and my grandmother gave me a share of Nike stock for my 12th birthday. And that's really where this all began. And I share this because I think at that age, I was very enthusiastic. She'd give me the Nike stock. It had split almost immediately after I received the share. And for people who don't know what splits are, it's basically when a stock price gets high, the company divides the price in half, and then they issue another share so that you just have more shares, but it's worth the same amount of money. But to a 12-year-old, you suddenly had one share, and now you have two, and it split, I think, a few months after that, and I had four. And ultimately, I think I got up to 32 shares from all the different splits, and they were sending me dividend checks in the mail, and I was totally hooked on the fact that someone was giving me money because I was holding this piece of paper. And my grandmother, who actually came from a real estate family.
Oh, cool.
My family, there's it's commercial and multifamily residential real estate company. And she was very passionate about telling me, hey, this Nike, it means you own a piece of that company, of those shoes that you're wearing and that t-shirt that you're wearing. And I really was fascinated at a young age. I wasn't really a big reader. But I was asking my parents, hey, grandma says we should get the Wall Street Journal so I can look at the stock prices. And So to imagine, and I think this was probably age 13 or 14, imagine, your 13 or 14-year-old comes to you and wants to get the Wall Street Journal. Your parents are going to say yes. They're like, oh, we got to see what's going on here. So
Yeah.
ultimately, I think the passion was born there. When I went to college as an economics major and business minor, I did so with the idea that I wanted to do something in finance. I wanted to do something with stocks specifically. And by the time I graduated college, I started in an independent firm as a research analyst and trader, which was a wonderful opportunity to get my feet wet, to learn about the stock market. That meant there was a lot of stock picking. I was, I certainly, one of my early experiences was the financial crisis. So that was a tremendous opportunity to be learning throughout that. But over time, as I got my CFA, which is a Chartered Financial Analyst, and a CFP, which is a Certified Financial Planner, I started working with clients more. And I was young at the time, but to have account minimums and give what was effectively a young kid $1 million or more at that point in time was pretty big. And so I started to write, and I started writing emails, and I hid behind words because I did a lot of work and I felt like I understood what I was talking about. But that turned out to be a very fortunate event, that people wouldn't give me money unless they had read my stuff first. Because when you read, you can't really tell someone's age. And the first comment I always got was, wow, I would have thought you were about 10 or 15 years older. And that writing blossomed over time, such that I was writing for the CFA Institute's blog for a little bit of time. When I came to PlanCorp as the director of investment research, I launched a personal blog, which was just peterlazaroff.com. Shortly thereafter, started writing for Forbes and the Wall Street Journal, and started doing national TV. And then it's all kind of culminated to where I published my first book this year, Making Money Simple. And when I went from being director of investment research to chief investment officer here at PlanCorp, a lot of that move was part of a giant succession plan. Our founder, is still here. All of our founders are still here, but they were transitioning ownership and a lot of people taking leadership roles. And so my role today is to oversee the investment committee, to create and communicate the investment strategy to all of our clients. And that means being in all sorts of client meetings, but it also means being a megaphone for what the company believes in. So I was going to say that's the short story. That's actually maybe a long story, but that's how I got to where I am today.
Awesome. Well, I love it. One of my good friends, he's a hedge fund manager, and almost similar story. He just started off as like a 10, 11, 12-year-old. A family member got him interested, and he just started reading the publications. He would go to the library and study like Barron's magazine and all the different ratings magazines. And what's interesting, I did the same thing when I was in my early 20s. I got out of college, graduated, degree in computer science, and I worked for a bank. I was doing mergers and acquisitions. Well, at lunchtime, we had a corporate library, and I would go to the corporate library where everybody else was going out and having fun. I would go up there and study. And I was turning over, I was earning essentially an average of 20% on my money in mutual funds and stocks and things like that. And it was all just because I just took the time to learn and study, and I would talk to the other executives. I'd go to the board, I'd go to the annual stockholders meeting, met the president of the bank one time, and he came up one time and actually saw me in the library. And he goes, just really neat stuff. So that story I think is awesome, because I think a lot of people listening are going to say, wow, that's pretty, I did the same thing, or I know my neighbor did that, and look at him now. So it's never too late to start. I mean, if you're a 65-year-old kid, be a 65-year-old kid and go to the library.
That's right. Well, and I think if you're passionate about, there's so much benefit to learning, ongoing learning, just in general. It's really good for your brain for a number of reasons, but I just feel so fortunate to be in a field that I would do as a hobby. I read about investments like I read about baseball. It's just fun to me, and it's interesting. And with a lot of personal finance and with a lot of business ownership stuff, it's like solving a puzzle, and there is a right answer. With investing, there's very little black and white, actually. It's just many, many, many shades of gray. Right. But with a lot of financial decisions, I think that really appealed to me. It's just like solving a puzzle. Because you're a computer science background, you understand, the mental comfort in being able to complete a circle on something.
Yep. My favorite 2 words are if then.
Yes.
If this, then that. Or if that, then this. So in any case, just simple logic. But hey, if you wouldn't mind, I think for this crowd listening, if you could if you have like what it is you actually do, like if maybe even a case study, say here's a guy or a gal I worked with, and here's what we did for him or her, and maybe they had a practice, maybe they're a teacher, maybe whatever the case is, but kind of give everybody a sense of actually what it is you do, because then we can go into maybe a case study, things like that, timing and time frame.
I'll have to make up some names here because we can't share client data, obviously. But, I can think of a couple that came. The husband was a dentist. The wife was in a financial professional role, kind of at a bank. We'll call them Chris and Stephanie. And so, they'd built careers they really loved and cared about. And not only had they worked really hard to excel in their professional roles, but they'd also done a really good job to excel in their financial lives. And they were earning good incomes. They always maxed out their retirement plans. They're consistently contributing to other investment accounts. They had really sizable equity in their primary home. They had the right insurance coverage.
Mm-hmm.
When they came to us a few years ago, they weren't sure if they were missing anything or if what they were doing was optimal. They definitely felt like they were doing the right thing, but doing the right thing because they were such competitive and entrepreneurial spirits. They wanted to know if they could do the best things. And they knew they could be more strategic with their investments. And they were fairly certain there was a way they could improve their tax situation both now and in the future. And they were in their 40s. And so while retirement is far away, they did want to make sure that retirement was on their own terms. It wasn't, it was something they chose, not just something that happens to them. So when they reached out to us, it was really clear they were super smart. They were very self-aware. It was also very clear they were incredibly busy. Chris with his dental practice, Stephanie with her career, and then their family. They had kids, and I think they were just at a point where they didn't want to get bogged down trying to figure out everything on their own. And so, following our process at PlanCorp, we organized their financial lives, identified specific objectives to address, and within a few months of our first meeting, we were able to develop a plan that allows them to retire on their terms, optimize their investments to be more strategic, reduce their tax liabilities, which Stephanie was super pumped about, implement a creative funding strategy to create tax efficiencies in the present and future. And that had to do with both education funding and charitable funding and retirement funding. So they were, again, doing a great job saving. They weren't necessarily going in the order or in the accounts that would create the best tax efficiencies both today and tomorrow. We maximized their insurance policies while minimizing cost. There were a few gaps in their estate planning documents. And that's really important for protecting your assets and your family members if something happens. Chris, with his practice, I think that was probably one of the bigger ones where if something were to happen to him, his practice is worth something. And Stephanie can't just take it to the open market if he's not there. So we made some adjustments in the estate planning there.
Good.
I think most of all, giving them the access to technology just gave them such a better ability to understand and see everything in one place at a glance. And I think that's one of the things that financial advisors, or at least good financial advisors, can do, is that we have the tools and resources to show you everything more simply. Obviously, we can give you back more time. You can have peace of mind from a clear plan around your money. It gives you more energy and mental space to dedicate towards your family, towards your career, towards your hobbies. And I think the big thing we did is, we made intentional strategic financial planning for them. They're living life on their terms. They know they're making the right choices with their money. And I think that's a kind of case study that applies to just about anybody. I think it's really, it's self-serving to say that a financial advisor is a great investment because I am a financial advisor, but it's not rocket science. It's more like mowing my lawn, where I can mow my lawn every week and it looks pretty good. But once I hired a professional, they were doing the little things I didn't think of. They never got lazy on a Saturday saying, I'd rather go play golf than mow my lawn. And little they know it's going to rain the next day, and then the grass is really long and then you can't mow it. But the professional, he's there every time to do it, cutting the grass in multiple directions, seeding strategically, cutting grass different lengths based on sun exposure, little things I never thought to do. And while I did it myself and the lawn looked fine, when I hired a professional to do my lawn, it looked great and it was healthier. Not only it looked better, it was genuinely healthier. And so I don't like equating a lot of what we do to like surgery, rocket
Right.
science. It's something that everyone, all your listeners can learn. You have a lot of smart, entrepreneurial, ambitious people who really like to take the bull by the horns. They all can do it. But the question is
Right.
how much time. And financial
Right.
planning's not like going to the gym where you do it a couple times a week. I mean, it's an ongoing full-time job. So yeah, I mean, I think that's really the benefit that people who are very busy get out of it.
Well, I like the example, the case study you gave, because it's a lot of folks I work with that typically one of the members of the couple, one of the spouses typically is an entrepreneur, a business owner, and the other is coming from the corporate world. And the two are very complementary. But also you reminded me, one of my favorite examples, Robert Kiyosaki. A lot of people have heard of him. I've actually met him in person, Rich Dad Poor Dad. And one of his famous sayings was, and I've recognized this to be true in almost everybody who I've seen who's achieved great levels of success, not just with money, but businesses and things like that, is that they hire and pay for good people. It's just like anything in life. You go cheap, you're going to get cheap. If you want really good results, you're gonna invest in the right people to get you those good results. And the thing is, a lot of people will think, well, people who don't understand that, people who are just scraping by, will say, well, they can afford to hire those really good people because they're rich. And I will tell them they're rich because they hired the really good people.
I think that's right.
So I appreciate that. Hey, now how about if you could talk a little bit about timing? The reason I say this is, I study the market. I listen to people and read and take notes, and everybody, of course, is now saying, "Hey, we're poised for the next correction." But this thing is, the last correction, the big one starting in late 2007. People were calling for that for 5 or 6 or 7 years. Even the famous barons were calling for it in the late 90s. They were calling for the big correction, and it didn't happen until the late 2007, 2008, 9, and 10. So when you're, as far as timing goes, if you could give an example of a shift in strategy, like when the market's ascending and then maybe when the market's descending, because I will tell everybody listening, it's either doing one or the other. It's never, and the thing is, I'm 56 years old now, and I don't even worry anymore. I've been through some, of course, the big major recession, but mainly 4 corrections in my adult life. And I just learned to get used to it. It's going to happen. Just expect it. Expect it is going to happen. And don't panic. Just recognize it. Speak to people like you, Peter, and then adjust with whatever strategies seem to be appropriate. So if you don't mind, talk a little bit about that and maybe an example you have coming out of the last one or heading the last one, something
Sure.
to resonate with people,
Well, so a few things leading up to that. So I think it's important to remember when you invest in the stock market, you're being compensated for taking risk, because you buy stocks because they're going to earn you a higher return versus cash or bonds over time, but they're much more volatile. There's the expectation that you'll experience temporary losses, and the market, and let's just focus on the S&P 500 because it's what most people look to these days. That's not necessarily the whole market, but we'll do that for simplicity. The S&P 500 falls by 10% on average once every 12 months. And it falls by 20% on average once every 3.5 years. And so those 10 to 20% drops are incredibly normal. And those are the types of drops that the media gets everybody hot and bothered about. And there's lots of headlines, and it does feel scary. There's nothing wrong with getting anxious about markets dropping. But the most important thing you could remember when you invest your money is those 10, 20% drops are really, they're not a bug. They're a healthy part of a well-functioning market. So you need to have those temporary losses in order to have those big gains. Now, the bigger recessions, the bear markets, those 30, 40, 50% drops, those also happen, obviously. Yeah. You mentioned you've lived through 4. It's something that everyone has to be aware of. And the one thing to also remember is nobody's going to predict accurately when it comes. So basically, you hear people make extreme predictions all throughout bull markets saying, here comes the next big one. Here comes the next big one. And if the market drops 10%, they said, see, that was the big one. That's not really the big one. They just need something to hang their hats on. Our general philosophy here at PlanCorp is that you're better off planning on the magnitude and frequency of these downturns continuing to reflect that of history going forward. So if I know that the market's going to drop by, somewhere between 20 and 50% once a decade, you can plan around that. And that has a lot to do with the initial asset allocation mix of stocks and bonds you have. As someone like you mentioned you're in your mid 50s. A lot of people in that age start to think, okay, I'm getting close to retirement. I can't afford to wait out a bear market. Well, keep in mind that the average bear market is shorter than 2 years. And so what we'll do here in doing a financial plan is we'll run something called a Monte Carlo analysis, where it runs thousands of different scenarios, different market environments, and try to figure out how likely is this plan we built you going to work, and what's the probability that we'd have to make a change between today and your age 95. We assume people live to age 95 because if you're married, there's a 50% chance one of the two people will live out that long. So as we're doing this planning, we put in those historical drops so that they match the frequency and magnitude. But I have a wonderful chart that if this wasn't that I love to point to, and maybe I can give to you to put on show notes, where it shows the average bull market and average bear market. And the average bear market is disproportionately shorter, and the losses are disproportionately smaller than a bull market's length and gains. And so if you worry too much about the corrections, you're going to end up missing out on what you were in stocks for the first place. And Peter Lynch, famous fund manager, Peter Lynch, has a great saying: more money has been lost in anticipation of corrections than in corrections themselves. The important thing is to have a plan for that correction. So you need to know what are going to be the trades you're going to make, what are going to be the rebalancing, what tax things are you going to do, what funds are you going to do. And the things that we're doing with our clients now, because, hey, we're about 10 years into a bull market, people who are approaching retirement, the big risk to this Monte Carlo analysis that we run, where there's thousands of scenarios, is something called sequence of return risk, where you have bad returns in the 1 or 2 years leading up to your retirement and bad returns in the first year or two of retirement. And the reason it's the time is most people don't have income coming in and they are drawing from their portfolio for the very first time. Now, for many of your listeners who have real estate, maybe they're still getting some income and that helps. But what we'll do is something called a safety net analysis to see what is your runway between cash, income, and bonds. If we drew down all your cash and we only spent your dividends and interest and income from whatever different sources you have, how long can you go before you have to touch your stocks? Because the real key here is you just have to be able to outlast a bear market. And if I tell you that the average bear market is a little under 2 years, well, then we're definitely a 2-year kind of runway is what we're looking for. We like people to retire with 1 to 2 years of cash in hand, so it just completely eliminates that sequence of return risk. And even better, if you do have a bear market or recession in retirement and you have this dry powder, you have a very unusual chance to make a big investment in retirement that most people don't get to make. And so it's kind of a few of the ways that we're preparing for people as they head into or just enter retirement. For those who own their own business, I think, the exit plan is important to have well in advance. I mean, you should be thinking about your exit plan, not 1 or 2 years before you exit, but 10 years before you exit. And so having things in place for those too, so that if you build that into the financial plan, you have some wiggle room to understand the implications of retiring, early, or if you have to get out, or, do you have the flexibility to truly do whatever you want?
Yeah. Well, that's awesome. I appreciate it. You hit on a lot of good things in there. It's interesting because the more experience I gain, the more I realize the most profound truths are often the simplest truths. And I think we sometimes overcomplicate things. And I mean, the title of your book is ideal. So, making money simple. We don't need to make it too complex. I mean, our brains think if it's not complex, it's not good. But that's really not true. In fact, I've probably made the greatest gains in my life from really just hunkering down, for lack of better terms, and simplifying and focus on 1 or 2 or 3 things and not allow myself to try to do 100 things and make it rule an elaborate, complex scheme or systematized thing. So I appreciate you sharing that. And one of the things that came up when you were talking, I started thinking of how when the last shift came about, when the last recession hit us, it really it affected different parts of the country differently at different times. It was the strangest thing. I was up in Pennsylvania. I'm hearing about all my colleagues in California and Arizona and Florida. Just like I was actually in Florida in October 2007. when it was those first couple months where things just dropped like a rock and people were exiting the business like crazy. And I was back in Pennsylvania. I'm like, we're cruising right along just fine. It was like 2 years later before that market hit. Same thing with like coastal Virginia. But do you have any insight on that? Or like when you're doing your analysis or you're helping people invest, correctly, is there some logic behind the fact that maybe we'll do certain things in the Northeast that we won't do in the Southwest? And any examples there? I know it's kind of a strange question, but I know like in Texas, so even within the state of Texas, certain parts of Texas got clobbered. Other parts, they never even saw the recession,
It's a good question. So let me kind of tackle it from two angles. From like a strict investment portfolio perspective, we're not going to be, inter-country regional, tactics, because there's no like Virginia index fund or California index fund, unless you consider a technology fund, the California index fund. But
there you go. Yeah.
but there are things that you can do on the planning side of life that can take these regional differences into account. And I'm based out of St. Louis, and the housing market definitely got hit, but not the same way. And it definitely got hit. Everything got hit. And there was a little bit of delay, but in our California office or our clients, that those housing prices were very, very different, and also the type of leverage that people were taking were different. And so when prices went down, and also notably interest rates went way down, if you're a business owner, there were a lot of opportunities. If you were leasing a place, maybe you bought it. That those places where the prices were more volatile, if your financial house is in order, it gives you the opportunity to take on financial risk opportunistically. And so at a time like the last recession where real estate prices were down, you could refinance your home. Hopefully you didn't have too much debt where you were in a home that you couldn't afford. But really, I think what a lot of entrepreneurs is they're leasing office space. Suddenly you couldn't, people were dying to get this stuff off their balance sheet. And so it was an opportunity to buy in certain areas. And I think regionally there were areas where the opportunity was larger because the price fall was greater. And the other important part of that is with the tax and estate planning. So if you end up having an estate tax liability, the recession was a really good time to do things like a grantor retained annuity trust or a GRAT, where you could stick different assets into this vehicle, and any growth over some interest rate like 2% was completely removed from your estate. And so imagine taking a $100,000 index fund or a building and you put it into a GRAT. And you look at it after the end of, and you can set the term to whatever you want, 2 years, 3 years, 5 years, 10 years. Any of the growth above 2% got removed from your estate. And so when prices were at all-time lows, that really created an interesting estate planning opportunity, because you could suddenly transfer a lot of wealth at very low cost, doing something that isn't really all that complicated in the grand scheme of things. Because as you mentioned earlier, if we have all these complex problems, the solution doesn't necessarily need to be complex as well. And I think with the property ownership stuff, people being opportunistic is probably where the regional stuff played out more. Once you already own assets in those regions, you're kind of stuck. You might be able to, again, because the loans were, they were basically giving away money. And even today, interest rates are still historically very, very low. But they weren't as low as even 5 years ago. So it definitely does present opportunities. I think the lesson that everybody learned at that point in time is to view those assets on their balance sheet differently, not as a traditional investment, not as a no-lose proposition, but a place to be opportunistic, a place to diversify, a place to do more unique tax and estate planning strategies in order to maximize your wealth across the board.
Yeah, that's an awesome answer. But one of the things you mentioned kind of struck a chord with me too, on a positive way, was the fact that sometimes geography is more about the sector. So like I was just spent a couple of weeks out in the Bay Area, of course, Silicon Valley and all that, and Tesla's out there and Facebook and all those. And, it's a very wealthy area and a very busy area. And so the recession of 2000, that was strictly a tech recession. And then if you look at the big one in 2007 through 11, that was real estate driven, right? You
Yep.
look at the one at the late 80s, that was driven by the S&L crisis. And
Yep.
right before that, the 1986 Tax Reform Act of 86, then you had the crash of October 87. In any case, if you look back, there's a lot of lessons in history. And a lot of time people think, well, the whole world is going down. It's really not. It may just be one particular sector. Now, the last one pulled everybody in. I mean, it doesn't matter where everybody got pulled into that party.
Financial crises tend to bleed everywhere. Yeah.
Yeah. Yeah. So looking forward, I mean, I'm excited about the future. I know we're going to have corrections. Like I said, I just learned to expect it. And, but we're kind of getting close to the end here, but any words of wisdom you can think of sharing about the future and would help. And also maybe a little bit about what your big why is. I know it's a rhetorical question, but what I like to remind people of is, a lot of us are coming together because we have the common denominator if we want to make more money and build more wealth, which is true. But what I learned is I now measure my success in terms of like time, like experiences, relationships, things like that. So the money is simply a measurement of the overall success, but it's really what it does for you that drives you sometimes. Like maybe you've got a favorite charity or a family member that, whatever it is, if you don't mind sharing. I know sometimes it's a personal question, but what I want to let people know and understand is that we're all just humans, and there's probably something that they can read out of what you're doing or what you've experienced that they can apply to themselves. It's a great philanthropical thing to do, to share yourself that way,
Yeah, of course. Well, there were two questions there. What do I see in the future? I will say that, there will be ups and there'll be downs in investing. Everything's cyclical. And I want to remind people that not all recessions are like the last one we had. That was a very severe one. A run-of-the-mill recession can sometimes start and end without you even noticing. If you read the papers every day, you'll notice. But, I personally try to read publications like The Economist that only comes out once a week, as opposed to the Wall Street Journal every day, because, there isn't something that truly should be changing the value of your portfolio on a daily basis. Obviously, portfolio values change every day, but, I think about trying to read things that will be relevant 12 months from now, as opposed to things that won't have any relevance 3 days from now. So that's kind of the future piece. In terms of the why, I think it's a really interesting question. To me, money is a tool, and wealth, real wealth to me, is the ability to do what you want, when you want, with whomever you want, and however you want. And so that looks different for everybody. And I will never be the type of person that wants to own 6 houses or 7, as I say, 6 houses on each continent, a house on each continent outside the US. So 7 houses in all. I don't need that. I'm not going to have boats and planes. That all sounds like fun. But to me, wealth is really being able to make choices about my life that are using time the way I want to use it. Time is probably our most valuable resource. It's clearly scarce. It's limited. When you own a business, and so I'm a business owner myself, and you are just driving and you pour so much time and you ask, what is it for? Well, part of it's because I'm a competitive person. I like creating things, but I like supporting my family. I like spending time with my family. I do envision a life where I pull off the gas pedal, maybe before the traditional retirement age. At the same time, I don't think I'll ever retire because I do love to work. Now, I reserve the right to change that opinion in 20 years, but I think that when you think about wealth and the things that we do for our clients, it's really just about making smart money decisions to help them fulfill their values and their goals. And you do it that way by getting their whole financial house in order, but they eventually come to learn that wealth is just a matter of, if I wake up and I want to go do something with my family, that I can, or if I want to go travel somewhere, if I want to go to a restaurant, or if I want to buy shoes, not worrying about it, not worrying about every financial decision. That's what kind of drives me personally from a strictly wealth. And you mentioned experiences. I mean, the research is overwhelming that experiences, spending money on experiences drives happiness far more than just buying stuff. The other things that drive happiness from your money are purchases that create time, giving money away to others, and finding ways to make your purchases a treat. So, if you're going out to dinner every night, that's fine. And, we're terrible cooks at my house, so it's almost a necessity. But finding a way to make that more of a treat as opposed to just part of a standard of living is also a decent exercise just to get more fulfillment out of life. I will mention, because I know we're probably running up on time, but the there's so many things we covered, and there's always opportunity to improve your finances. I encourage people, whatever they're listening to, there's probably there's a piece of paper on your desk or on home on your counter, or there's something you should be taking action on. Just do that one thing today, because the impact from it compounds over time, no matter how small it is. I developed a resource called smartmoneyquiz.com. It's 9 questions. It kind of just points you in the right direction if you don't know where to start. And I have a lot of resources on my website, peterlazaroff.com, that you can download. Or if you're interested in learning more about PlanCorp, you can go to plancorp.com, learn all about the services we provide for our clients.
Awesome. Well, I appreciate you sharing that. So peterlazaroff.com, plancorp.com, and the book is Making Money Simple. Is that right?
That's right. And if you want to take the quick quiz, it's smartmoneyquiz.com. Lots of URLs for you and all the listeners. Yeah.
Smartmoneyquiz.com. So, well, listen, Peter, I really appreciate you sharing your precious time, speaking of time. I know it's valuable, and I really appreciate you taking time to do this and help the community that I'm serving. And it comes down to prosperity through service. I mean, you serve first and you shall prosper as a result. And I think people sense that you're a pretty good guy. And everybody listening, take Peter up on his offer. Take the quiz, Smart Money Quiz, and see where you stand. Just do it for fun. Do it on a Friday night when you're done for the week. And for everybody listening, I think I speak for everyone, Peter, when I say thank you on behalf of all of us for doing this too. And for everybody listening, again, subscribe. Go to iTunes, iHeartRadio, Stitcher, all of them, and look for real estate investing for professional men and women. Again, it's that's one of the pillars, but that's where my experience is. But I bring people like Peter on because he's much more of an expert than I will ever be at that part of the business. And you run your own business too. And if we can help you leverage what you're doing, I know what it's like to own a business and run a business. I've had 7 of them, and we want you to know that there is a path where you can shift from using your time to buy money to using your money to buy time. We just finished this up with. So have heart. Know that there's people out there willing to help. I love meeting people. I can always tell when someone's passionate about what they do because they want to tell others, and they often will write books and do things like podcasts. So God bless you all, everyone. We will see you next week.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.